Hi, and welcome to part 3 of market efficiency. In this topic, in this part, we look at how we look at the implication of market efficiency on the decision-making process of investors and managers in the financial markets. The readings for this topic is once again chapter 16 in the textbook. The lecture outline includes 2 parts. So we look at the implications of market efficiency for 2 groups of decision makers. We have investors who have to make investment strategies, and we have the corporate insiders being the managers. So the learning objective for this part is to understand the implications of the evidence of market efficiency for investors and financial managers. This is the outline of the issues that we talk about. So in terms of the trading strategies, as we know, there are 2 types of investment strategies, either an active investment strategy or a passive investment strategy. With active investment strategies, the basic idea is that we don't believe in market efficiency, right? So we believe in share markets being mispriced, at least from time to time, right? So sometimes we would be able to identify mispricing opportunities. So depending on the types of information we're talking about, we would have different kinds of strategies that we could use to exploit the inefficiency in the market. So we mentioned before that there are 3 forms of information being 3 forms of efficiency, being the weak form efficiency, where we talk about past information being incorporated fully into the share prices. We then talk about a semi-strong form efficiency, where all the public information is incorporated into prices. The strong form efficiency talks about both public information and private information. So we know that insider trading is prohibited in most of the exchanges in the world. There's a very sound reason for that. So exchanges, what they want to do is they want to attract trading from different people. So imagine we are an outsider of a corporation, right? So we are either a retail investor or a institutional investor. But the point is, we don't have all the information about the company compared to the manager. So we only trade in the market if we are confident that we will not be exploited by the corporate insiders, right? So we're not going to be fund run by corporate insiders. So from an exchange point of view, if we want to encourage trading by retail investors or institutional investors, we have to make sure that they believe that they are not going to be exploited by corporate insiders. So for this very reason, exchanges around the world prohibit insider trading, right? So managers, even though they have inside information about the firm, they are not allowed to trade on that information. And therefore, most of the time, we would expect the market to be at its semi-strong form efficiency, right? Because private information, by definition, should not be allowed to be incorporated into share prices. So given that there are only 2 types of information that is relevant in this case, either past information or public information, we'll talk about trading strategies that exploit these 2 types of information, right? So being the technical analysis or the fundamental analysis. We also then discuss trading strategies by people that believe in market efficiency, right? So we talk about passive investment strategies. The second focus of this lecture is on the managers. So given the different levels of efficiency in the market, how does that affect managers' actions, right? So from a manager's point of view, there are 2 important interactions between the manager and the outside financial markets. The first one being announcing information into the market, right? So you have financial reports, for example, or you have M&A announcements, mergers acquisition announcements. Yeah, so material information has to be disclosed to investors in the financial markets. The issue here is if you believe that the market is efficient and people are rational, then people will be able to react appropriately according to information, right? However, if you believe that the market might overreact or underreact, and from time to time, you might want to time the announcement at the time when it works in your favor, right? So, for example, if you have negative news, and you know that the financial markets tend to overreact during reporting seasons, then you might want to spread out the negative news, and you might want to avoid the financial reporting season, right, in announcing those news. The second issue for managers is to issue securities into financial markets. So once again, if we believe that the market is very efficient, then timing security issuances doesn't add value, right? So the markets will always be able to price your security correctly at any point in time. But if we believe that markets are inefficient and sometimes investors overreact, sometimes they underreact, then it might make sense for managers to time security issuances at the time when they get the most value out of their issuance, right? So these are the issues that we talk about in the last part of market efficiency. So we start first with technical analysis. So as we mentioned before, this is an active trading strategy where our goal is to identify mispricings in the market. And the mispricings here come from historical prices, right? So the whole idea here is that we're saying that past information is not fully incorporated into current prices, and therefore it's possible that we can form profitable trading strategies using historical prices. Yeah. So this is more or less a short-term trading strategy where we're trying to exploit short-term patterns, right, in the share prices. So this is not something totally new. This is something that we mentioned before in the previous weeks, right? So suppose that we observe this pattern in the share price where we could identify cycles in share prices. Yeah, so we could identify the peaks and the troughs in historical price movements. So based on these patterns, if I use the past price cycles, I am able to predict future price movements, right? So if the price is currently here, I think it's reaching its peak. So the future short-term price movements would therefore likely to be a decline, right? So if I could do this, it means that I could form my trading strategies to exploit the share price movements in the future, right? So if I believe, for example, I'm standing here, I believe that this is the peak of the next cycle. What I could do is that I could short sell at this point, and then when the share prices go down to where I believe is the trough, I would then buy the shares, right? So I short here and I long here, and this is my profits. Yeah. So based on this strategy, I will be able to make profits if the historical share prices follow a certain pattern, right? So empirically, people find that even though this strategy sounds reasonable, but people actually find that after taking into account transaction costs, this strategy is not very profitable, right? So we find evidence both in Australia and globally that technical analysis does not yield abnormal return, right, after transaction costs. We then look at the second commonly used trading strategy, which is the fundamental analysis. So fundamental analysis is more or less the long-term view, right? So the idea here is that we're saying that even though information is public, but the market might systematically misinterpret the information, right? So for public information, even though they are public, but the prices in the market might not fully reflect the information because the market somehow systematically misinterprets the information. So the key point here is systematic, right? So we mentioned before in the previous weeks that market efficiency implies that there will be sometimes where the market misprices securities, but overall the mispricings would be random, and therefore there should be no single investor that could earn abnormal returns, right? So the idea of fundamental analysis is that there is some systematic bias that cause investors to underreact or overreact to public information, right? So if that's the case, only when this is the case, then we are able to identify undervalued and overvalued stocks, and we can set up our investment strategy accordingly, right? So if we believe that the market systematically misprices the security, and if we believe that we have a better ability to process information compared to the market, then we are better at finding the fair value of a security, and therefore it's possible for us to identify undervalued and overvalued stocks, right? So the profits here come from public information, yeah? So people that use fundamental analysis are those that believe that the market is not in its semi-strong form efficiency. So in the previous slides, we talked about active investment strategies, where our goal is to go out into the market and identify mispriced stocks, right? And we set up our trading strategies accordingly. So with technical analysis or fundamental analysis, we believe that we can beat the market. If we believe that we can't beat the market, or if we believe that the market is very efficient, then what are other strategies that we can do, right? So with passive investments, this is when we believe that the market is efficient and there's no point trying to beat the market, yeah? So one argument here is, if the market is efficient, then would a random selection of securities be the best investment strategy? The argument here is that while the efficient market hypothesis says that all securities are correctly priced, so share prices on average is always fair, right? This doesn't imply that investors should select their investments randomly, right? So random selection is not a product of the efficient market hypothesis. So there are two reasons for why a randomly selected portfolio is not a good idea for a passive investor. The first one being depending on the number of stocks that we randomly select. If the number of stocks is not large enough, then the diversification benefit might not be maximized, right? For example, a product of random selection might result in stocks in the same industry being selected, and in this case, by definition, we're not diversified, right? So even with the random selection, we might end up with a portfolio that is not well diversified. The second reason for why random selection might not work for some investors is because some investors have different risk preferences compared to the market portfolio, right? So if the investor is more risk averse than the average investor in the market, then the market risk itself is a bit too high. So for this investor, it makes sense therefore to mix the market portfolio with some risk-free assets, right? Or with low-risk investment like bonds, or like government bonds, for example, or short-term securities, yeah? Buy and hold policies is another type of passive investment where the investor has a long-term view, and what they do is that they will buy a selection of shares, and they hold the shares until maturity, right? Until the end of their investment horizon. So with buy and hold policies, the benefit here is that we minimize transaction costs. So the less frequently we trade, the less transaction costs that we have to pay on our trades, right? So with buy and hold strategies, the big advantage is that transaction cost is minimized. Also, empirically, we find that in general, buy and hold strategies tend to perform quite well compared to more frequent trading strategies, right? So, for example, in Barber and Odin in 2000 and 2001, they find that 20% of households that trade more regularly earns 8% lower compared to the average for the whole sample, right? So the more frequent traders actually underperforms the other trader after taking into account transaction costs. We next look at the issue of using share prices as the measure of firm performance, right? So the common practice is that we look at share prices as a reflection of the performance of the company, right? So when we see an increase in share prices, we think that the company is doing better. Also, another common practice in the literature is to use share prices or share returns as a benchmark, right? So if you have like a market index, for example, you use the market index as the benchmark to measure trading performance of other type of investment strategies. So how does this practice relate to the efficient market hypothesis, right? So if we believe that the market is efficient, then the current share price is the best estimate of a company's true value, right? So if the market is efficient, share price reflects the fair value of the company. However, if the prices are not efficient, then we have a biased estimate, right? Also, when we look at past share prices, the past prices should reflect past performance of the company. Also, the price behavior is likely to be related to management and its action, but may also arise out of exogenous factors, right? So any factors that affect the performance of the company would be reflected in share price. But the only caveat is that the market has to be efficient for the estimate to be correct. So to sum up, the implications of market efficiency is that if we believe that the market is efficient, at its semi-strong form at least, then it's not possible for an investor to try to beat the market. So the best strategy here is to follow the market, right? So this is the idea under passive investment, especially used by a lot of index funds, right? So the argument here is that we should try to minimize transaction costs rather than trying to spot mispricing, right? So in terms of the implications of market efficiency for corporations, we look at a few decisions. The first one being project selection. So from a manager's point of view, they face some uncertainty when they choose a new investment project, either in developing a new product or in buying or acquiring an existing company, right? So the nature of investment is a very complex process because there are a lot of uncertainty involved. So if a manager is not confident in their ability to tell the true value of a project, then they can look at the stock market reaction when they announce the project into the market as an estimate of how shareholders think about the investment project, right? So if, for example, if a company intends to acquire another company, and when they announce the acquisition proposal into the market, and they are met with negative stock market response, then assuming that the market is efficient, shareholders know what they are doing, then that negative response indicates that the investment or the acquisition is not a good idea. Right? So managers can use the share markets, or they can rely on market wisdom to guide their project selection. The next issue that we look at is announcing news into the market, right? So communicating with the market. So if the market is efficient, then the announcements of news into the market would elicit responses that reflect the true value of the information, right? So as we mentioned before, for some managers, if they believe that the market is not efficient, and sometimes they are able to hide bad news by announcing information in periods where shareholders don't pay much attention, then they can actually time the announcement of certain news accordingly, right? So we mentioned before that during reporting seasons, companies tend to avoid announcing bad news, right? Because that's when investors' attention is the most. Yeah. We then look at the issue of issuing new securities. So the issue with issuing new securities is that when you issue the security, the proceeds that the company gets depending on how much the shareholders are willing to pay for additional shares, right? So if the market is efficient, the new issuance would be priced correctly, and therefore the price that the managers get is the fair price depending on the firm's value, right? Whereas if the share markets misprice securities from time to time, then it makes sense for shareholders, or it makes sense for managers to time the security issuance at the time when they believe they get the most price out of their shares. Right? So as we mentioned before, if the market is efficient, shares will be priced correctly, and therefore timing doesn't matter. Timing will only matter if a company's managers have information suggesting that the company shares are mispriced, right? So that's where the signaling effect comes from, yeah? So the market believes that managers only issue shares when the shares are overpriced. Alternatively, if the company's shares are underpriced, it doesn't make sense for managers to issue new shares into the market because they get less price. Right. So this concludes the market efficiency topic. So we went from discussing the idea, the market efficiency hypothesis, where people believe that market prices always reflect all information about a company. We then look at the empirical evidence of the market efficiency, the efficient market hypothesis, and we find that overall, market efficiency is a very complex situation. So sometimes we do find that the market is efficient, at least at the macro level, but sometimes some evidence points towards market inefficiency, especially in small stocks, right? In terms of public announcements, the dominant evidence in the literature is that people tend to underreact to earnings announcements, right? So when there's earnings announcements, we always see a delayed response in the market. So that by itself is a strong evidence against the semi-strong form efficiency hypothesis. Right. We then discuss behavioral finance, where we challenge the belief that investors are rational. Right? So when we take into account the irrationality of investors, we see that sometimes market prices reflect both the value of the firm as well as investors' biases, right? Psychological biases. In the very last topic, we look at different implications of market efficiency for different types of market participants, right? So topic 3 is only just an extension or an application of the market hypothesis, the market efficiency hypothesis. So this concludes topic 4 of corporate finance.